Hey guys, this is Victor with LMS CPA. It's great to see you again. And in today's video, we're going to be talking about how to increase your wealth and lower your taxes at the same time. But before we do that, let's take care of the homework as always. Find the like and subscribe button and press like and subscribe. Taking care of that already? Awesome, thank you so much. So my purpose in these videos, guys, is actually to share with you my experience as a CPA, give you my perspective, and also give you information that might be helpful for you in your business as well as in your personal finances. So you own your own business or you're self-employed and you feel like you're not getting ahead, you're not advancing. And you feel you're not advancing because you might be overpaying taxes. So in today's video, guys, I'm going to give you an example of a client of us, of a friend of ours, that was able to actually increase his wealth while he reducing his taxes. So if you want to be like our friend and client and you want to increase your wealth while reducing your taxes, stay tuned. 3, 2, 1. So let's take a look at some stats here in the US, right? So about 2 million Americans actually overpay taxes, guys, in the tune of over $1 billion. And the reason for that is primarily because they do not consult with a tax advisor or a CPA that's able to help them, give them consulting and advice on how to reduce their taxes legally, right? They often go on traditional do-it-yourself programs and softwares and or talk to advisors that actually gonna help them as much and end up paying taxes or end up overpaying too much taxes, right? Another aspect, guys, is that if you are a small business owner or a self-employed individual, you may realize that the standard deduction doesn't take you so far. You end up still paying or overpaying taxes. Number 3, many business owners and self-employed people are so busy that they're so busy running their businesses, right, and operations that they do not take a look at their finances and taxes on a continuous basis. And they are not aware that the IRS allows them to actually go back up to 3 years and take a look at what were some of the items that they could have included in their taxes, personal and business, that could have given them a better tax outcome. So in the year here, 2022, you can actually go back to the years 2020, 2019, and 2018 and find what are the areas of deductions that you missed just because you were not aware or because you were not given the right advice or because you actually forgot to include additional expenses that you didn't include in your original taxes. Well, you can go back, amend your taxes, and qualify for what's called an amended refund, okay? So you have 3 years to go back, so go ahead and do that now. Millennials are a good chunk of what it's called the gig economy. A great percentage of the people that work in the gig economy actually are millennials. And oftentimes they are trapped in what's called the double taxation. So if you want to make sure that you are not subject to double taxation, make sure that you consult with a CPA or a tax advisor so you can get more information on that, as well as making sure that you don't get trapped in the double taxation. Even startup businesses or bigger businesses or mid-sized businesses can qualify for what's called research and development credits, right? Or even film credits. These credits, guys, reduce your taxes on a dollar per dollar basis. So if you owe, let's say $25,000, $50,000 in taxes or $100,000 in taxes, and you qualify for some of these credits, actually the credits can reduce your taxes on a dollar per dollar basis, okay? We've done some videos on that, and in the future, we're gonna keep doing more videos and more content in regards to credits because a lot of you guys have been asking for that information. So in the future, we're actually gonna be doing some specific videos as it relates to credits because I know you're gonna take great advantage of that. So in today's episode, we're going to be talking about how a business owner actually reduces his taxes by investing in real estate. So a client actually operates a business in the technology sector. His profits are about $500,000 in profits, right? And his taxes would have been, by being a C Corp, about $100,000 without considering the state taxes. And here's what he did. He decided to invest in real estate because he understands the real estate market and the real estate industry. his appetite, goes with real estate. He feels comfortable in real estate and he has experience in real estate. He's done it before, right? So he understands the market and the industry, and he understands the financing and mechanics around it. So, guys, that real estate historically, number one, has been a great hedge against inflation. And we've talked about inflation before. So see the description below so you can see our episode on inflation in 2021. So real estate appreciates in value. Real estate can give you passive income. Mortgage, interest, and taxes are tax deductible. And depreciation can be a great, massive tax write-off. However, our client's secret weapon, in this case, it's called cost segregation study. What is the best time for you to do a cost segregation study? Number one, when you acquire the property. Number two, when you construct the property. Or number three, when you remodel the property. Cost segregation study, guys, allows you to divide the property in 4 different quadrants. Number one, 5 years. Number two, 7 years. Number three, 15 years. And number four, 39 years. Okay, so on the 5 years, you're gonna take the items within the structure that the useful life is 5 years. On the 7-year category, same deal. You're gonna take the items on the property that the useful life, it's 7 years. The same for 15 years. And then the general structure is 39 years. Note that in order for you to do a cost segregation study, you have to hire a qualified engineering firm that's going to certify the study for you. So going back to our client's example, actually, he understood the industry, right? He understood that he needed to hire an engineering firm. He knew that he could increase his wealth because he could have tenants paying rent. Real estate is a great hedge against inflation. It appreciates in value. And he understands that depreciation, in this case, by doing a cost segregation study, will give him a massive advantage when it comes about tax write-offs and deductions for tax purposes. As you see, guys, there's always one way for you to increase your wealth while you're reducing your taxes. So the most important thing, guys, is that you want to make sure that you talk to your advisor, you talk to your CPA, you do your own research. In this case, you want to make sure that real estate is for you, right? That you understand it, that you have an appetite for it, right? That you can finance it, and that you know how to manage it, right? Because one thing about real estate is owning it, right? Understanding the mechanics of it, but also the management of it is very, very important, right? That's where a lot of real estate investors actually get trapped into because they have jobs or other businesses. And then when it becomes time to manage their real estate, actually they fall into that trap, okay? And they cannot get out of it, or it's very hard for them to actually manage different things at the same time. As always, guys, thank you so much. Like and subscribe, and we'll see you in the next one.